Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, August 4th, 2023, and for many years now we have partnered with the Moore County Chamber of Commerce and sponsored their annual economic forum held in January, or typically in January. But the last 2 years, Linda Parsons, the CEO of the Chamber of Commerce, has asked if we would provide an update to the members in terms of what we are seeing in the economy, and that is the purpose of today's video. Now, we can't get too far into this presentation without throwing up the disclosure document that says that this video is for informational purposes only. Obviously, if you have any questions on anything we discussed today or anything that we don't discuss that you are curious about, by all means, feel free to reach out to us. You'll find all of our contact information at hicks-associates.com. On the screen is also my QR code. You are welcome to use that if you are so inclined. That said, we do have an office in Cary, North Carolina, as well as Southern Pines, and our office in Southern Pines just recently moved over to West Pennsylvania Avenue. And if you are not familiar with Nathan, this is Nathan Cherry. He runs the Southern Pines office. You'll find his contact information on the screen as well. Now, that said, who are we and what do we do? Hicks & Associates Wealth Management serves individuals and families in a proactive capacity with data-driven solutions and counsel. We serve our clients by being intimately familiar with their finances so we can proactively guide their financial decision-making, and again, we like to say with data-driven answers. Now, for most of our clients, we also serve as portfolio manager, managing their investments in a truly active fiduciary and a fee-based approach. Again, if you want to learn more, feel free to visit us and reach out at hicks-associates.com. Okay, commercial over, let's dive in. And I would be remiss if we didn't start off by talking about that which hit the news earlier this week, and that is the United States long-term debt being downgraded. So the credit rating agency Fitch, just earlier this week, I believe it was on Tuesday, they downgraded the long-term rating on our nation's debt from AAA to AA+. Now, it is important for you to understand what they're not saying. Fitch is not saying that they believe the United States government is going to default on their debt. That's not what they're saying. They're simply saying it is trending in the wrong direction. And if you actually read their release, it says, in Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. I would certainly agree with that statement. Now, earlier this week, as soon as this came out, we had some very famous investors, I won't name names, but they came out and they stated that they disagreed, that Fitch never should have downgraded our nation's debt. The United States government is not going to default, etc. There's been a lot of talk about this in the media. Even Treasury Secretary Janet Yellen has discussed this and vehemently disagrees with Fitch in this regard. Now, I'm going to disagree with all of them. I think this downgrade is long overdue. So on the screen right now is our nation's total debt as a percentage of GDP. Now, this is something we have shown many times over the last year or two. Now, that's also a good time for me to mention, if you haven't already, by all means, feel free to hit the subscribe button on our YouTube channel. We post a weekly video. It's usually at least once a week where we'll provide updates on the stock market, the economy, general financial planning topics, etc. It is, again, it's on YouTube, so it is open to all. You do not have to be a client to hit that subscribe button. We would love it if you would. Naturally, if you find these videos helpful, by all means, hit the like button and feel free to share them as appropriate. Now, that said, this chart is showing a total debt as a percentage of GDP, but it is important to note that the bottom of the chart is not the zero line. In 1980, it looks like we're at zero. That's not true. We are actually at about 30% of GDP. Now, if you recall from history, President Reagan dramatically increased our nation's defense spending, and that created a lot of debt. Now, that is typical. By historical standards, our nation goes into debt to fight a crisis of some variety, usually a war. So in this particular case, President Reagan and Congress increased our nation's defense spending, which created a lot of debt. And you could see that the total debt as a percentage of GDP went from about 30% up until about maybe about 50%, plus or minus. That is fairly dramatic. Now, again, by historical standards, the nation then begins to pay that debt down. There has been a couple of times in our nation's history where we've actually been debt-free as a nation. But unfortunately, you can see this trend. The trend has been up. So in the 1990s, the nation was paying down the debt, and that's great news. But then we had the dot-com crisis, and it started to rise again. And then we had the global financial crisis, and it really jumped. And this is really the problem. And I would contend this is really what Fitch is talking about, because you can see there was no effort. There really hasn't been an effort to pay down any of the massive amount of debt that we created as a result of the global financial crisis. It has simply just continued to grow. And then, of course, we had coronavirus, and then the debt increased even more. Right now, we are at 118% of GDP. That is an insane amount of debt. And again, I won't bore you with all the details. We've done other videos on this topic, and I'm happy to take this offline if you want to chat about this. But debt is one of the leading causes of empires to collapse. Again, I'll leave that there. Now, the good news, if we can take some good news off of this chart, the good news is the recent trend has been down. But from Fitch's standpoint, that is why they downgraded the debt, because we have such a high amount of debt, and there doesn't seem to be a lot of bipartisan agreement to combat this and to bring spending down and to bring the debts down. Now, what does this also mean? Now, on the screen right now, we have the federal defense spending. That is the blue line. Here's the problem. As you know, the Federal Reserve has been fighting inflation. We'll talk a little bit about that today as well. And as they have been fighting inflation, they have been raising the federal funds rate, which then translates into just about every interest rate throughout the economy. And that interest rate is going to impact the amount of money that our federal government is paying in interest payments on all of the debt that I just showed you. So right now, we add the green line in. The green line represents the interest payments on our nation's debt. And now we see that our interest payments on our nation's debt is equivalent to our nation's defense spending. That is a very big problem, and I would contend that is why, or these are reasons why, Fitch downgraded the nation's debt. So that's current events. Now let's switch gears and talk about the economic update, and we're going to do that first by looking at a little bit of history to make sure that the stage is properly set. This is October 17th, 2022. It's an article taken from Bloomberg, and you can see the title. It says, "A forecast for a U.S. recession within year hits 100%. That is October 17th of 2022. What I want to highlight here is this happens to be the bottom. So far, this is the bottom of the stock market's correction from 2022, or the bear market bottom was October, I believe that's October 13th. And just a couple of days later, Bloomberg says that there is a 100% chance that we're going to see a recession in the coming year. Fast forward, we see December 20th, 2022. Bloomberg updates their forecast. They say it's a 70% chance for U.S. recession in 2023. Here's another one. This one is dated January 4th, 2023. And what I'm trying to show here is that there was a very high percentage of professional economists declaring that we are going to see a recession in 2023. This one is dated January 15th. Here's another one dated February 27th. You get the idea. Here's the probability of U.S. recession remains elevated. You can see that it's March 5th. And effectively, they're, again, saying 99% of their survey respondents are saying that there is a 100% chance that we're going to see a recession this year. So a recession is coming in 2023. Or is it? So on the screen now is our gross domestic product in terms of a histogram shown quarter by quarter. And what we want to talk about here is the fact that by historical definitions, a recession is when we have 2 consecutive quarters of negative GDP. Now, if you look on the right-hand side of the screen, you see first and second quarter of 2022, we had negative GDP 2 quarters in a row. By historical standards, that's a recession. However, what's interesting is that the National Bureau of Economic Research has become the de facto agency, if you will, that declares whether or not it was or was not a recession. So far, they have still not declared first and second quarter 2022 as a recession. Now, what's interesting is the National Bureau of Economic Research is not an official part of the government, and there's actually never been a declaration that they are the quote-unquote experts, and we're going to listen to them as to whether or not it was or was not a recession. To make matters worse, I just learned this yesterday. They don't actually have a rule that determines whether or not we are or we're not in a recession. It is simply done by majority vote. So the majority of their experts gets around a conference table and they declare, hey, first and second quarter 2022, was that a recession? So far, they have voted to say that was not a recession. So I just find that interesting. There's no actual rule that the National Bureau of Economic Research uses to declare a recession, and there's never been an official declaration that we have to rely on them. That said, we have been skeptics from the very beginning that we're going to see a recession in 2023. We want to talk about now is what the Federal Reserve is attempting to do and how that's going to translate or what they would like to see on this GDP chart. First of all, they're raising the interest rates and their quantitative tightening, and we won't get into the weeds on that, but those are the things that the Federal Reserve is doing in order to bring down inflation. What they want to do, their preference is to bring down inflation without making this histogram go negative. Now, Chairman Powell, Federal Reserve Chairman Powell, has stated that he would rather see a recession but know that inflation is under control as opposed to avoiding a recession but if inflation continues. So in other words, he's declared that in a recession, you're going to have employment is traditionally going to rise. And if that happens, a small segment of the population would be adversely affected, and we certainly would feel for them. However, if we don't get inflation under control, that's going to affect everybody. And so I would argue, rightfully so, they're trying to get inflation under control. And if they can do it without causing a recession, great. But if they have to cause a recession, then they're comfortable doing that because inflation is such a bad problem and it is so difficult to get out of the economy. And the longer it stays around, the worse the problem gets because it compounds on itself. So that's what we're trying to see here. We want to see this histogram come in a little bit, but we prefer not to see it go negative. So here's these red bars. That's what I'm drawing in to say that's what they would like to see happen. The economic growth come down a little bit, but then begin to expand again. That's what they would like to see. Well, just last week, we got an update on GDP, and we actually see that what's called the advanced estimate of second quarter GDP was actually greater than first quarter GDP. That is not recessionary. That's expansionary. Now, that said, we're going to start to dive deeper on these topics, and I'm going to pick up the pace. But this is how I'm going to do this. I'm going to do this with a quote-unquote scoreboard. And some of these charts that I'm going to show you a chart that I used back in March when I gave a similar presentation to another organization. Again, it was March, so it was March Madness. So I was using a scoreboard to keep score. This chart says it's a recession. This chart doesn't say it's a recession. So then we believe that we take a weight of the evidence approach. So if the weight of the evidence suggests there's a recession coming, then we believe a recession is coming. If the weight of the evidence does not suggest a recession, then we tend to be skeptics. So that's what we're going to do is we're going to use this scoreboard to keep track of all the charts that we're going to quickly start to go through. So up first is the yield curve. The yield curve is the number one predictor, if you will. It's the most reliable predictor for whether or not we're going to see a recession. On the screen is the 10-year minus the 3-month yield. And right now, it is indeed inverted. And inversion happens when that math goes negative. So when you take the yield on a 10-year bond and you subtract the yield from a 3-month bond, if that answer is negative, the curve is considered to be inverted. And you can see that the yield curve went inverted sometime in 2022, and it is still inverted. So historically speaking, this is indeed the most accurate predictor of whether or not we're going to see a recession, because so far, every single time this yield curve has gone negative, the nation has experienced a recession. However, as you can see on the chart, the start of that recession is of varying lengths of time since the curve goes inverted. Right now, we're only 9 months into this current yield curve inversion, and we've seen as long as 23 and 30 months, depending upon your definition, before we actually see recession. So again, so far, this is the most accurate predictor of whether we're going to see a recession. However, it is important to note that just because it has always been true, there are plenty of economic indicators that once upon a time were accurate but are now less accurate. It is entirely possible, for all kinds of reasons, that the current yield curve inversion is giving us a false signal. We can debate that later if you really want, but we have to recognize that it is entirely possible that this yield curve inversion is just giving us a false signal, or it's predicting a recession. It's just further into the future than what all of the pundits have said so far. Bottom line, we would argue the yield curve is indeed recessionary, so we'll put that on the scoreboard. Again, trying to pick up the pace. This is the manufacturer's new orders. This is the chart that I showed earlier in the year. At the time, I indicated that it's not good that it has ticked down, but I was not yet concerned that this was declaring a recession. So I put this in the inconclusive category back in March. But look at the updated chart. The updated chart is very clearly an expansionary chart because it has shifted so much higher. So we're going to put that in the expansionary column. So this is building permits. This is the chart that I showed earlier this year, and I indicated that it was recessionary, but it has made a strong beginning of a strong recovery. So I think I actually put this in the inconclusive category back in March. Well, if you look at the updated chart, it has kind of moved sideways since then. So I'm going to put this in the inconclusive category still. Now, I will also show you housing starts, and I don't actually put this one on the scoreboard simply because housing starts and building permits, they're very similar data points. But again, there's your nice strong trend. It was below trend. That's earlier in the year. The updated chart, we're still below trend. So bottom line, I'm putting that in the inconclusive category. Now we have manufacturing new orders. This one is in the charts or on the scoreboard. That's from earlier in the year, and again, it has risen, very similar to the durable goods orders. So we're putting that as expansionary. Now, the stock market is the next leading economic indicator. And the stock market is one of the key inputs that we would argue is suggesting that we're not seeing a recession in 2023. Now, as I record this, the month of August, the market has come in a little bit, and is the fact that the market's selling off a little bit, is that telling us that it's forecasting a recession? Well, no. Again, you can go back and watch their most recent video, our monthly market monologue. Historically speaking, August and September are not good months in the stock market. So just because the market is coming in a little bit right now, that doesn't necessarily suggest that we're going to see a recession. Right now, when we look at the stock market, we're in a very clear uptrend. It is not forecasting a recession, so we're going to put that one in the expansionary category as well. The next is consumer sentiment. This is consumer opinion, consumer sentiment. It is just a survey. This is not very scientific, so you definitely cannot use this for timing purposes, but that is the current chart, and we are classifying that as also expansionary. Again, if I go back to that for just a second, last year, all-time low in June of last year, the consumer sentiment survey was the worst it's ever been, but since then it has indeed recovered. And if you look at the far right side of the chart, it did come down, but it's rebounded a little bit. So I'm going to argue that that is a little bit expansionary. Now, credit subindex, what this is measuring credit risk. Now, again, this is what I was looking at earlier this year, and I was saying that this is not recessionary at all. It's recessionary when we go above that zero line, and at the time we were right there at the zero line, and it had come down. So that's not recessionary. Well, the latest version of this chart, again, measuring the risk of credit defaults, etc., that is, again, still coming in a little bit. It's, in my opinion, not recessionary. So we put that in that category. Next is unemployment, and I'm going to show you multiple different versions of this. This is the federal unemployment. You can see that we're at about 3.6%. And if you look at that green line at the bottom, I'm trying to show I'm trying to get this current rate in perspective. Unemployment is not this low very often. So this is a very good sign for the economy. The 7.5%, that's the other black line. That's this black line. The 7.5% represents the declaration from a couple of economists from the International Monetary Fund who declared, this is several months ago, they declared in a research paper that in order for inflation to be under control here in the United States, we're going to have to see unemployment reach 7.5%. Well, you'll see the inflation data here in just a minute. They've definitely brought inflation down, and we're nowhere near 7.5% unemployment. So this is, again, another comment that when you read the news, sometimes you just got to read it with a high dose of skepticism. But that's the federal unemployment. Since we're here in North Carolina, where's North Carolina? North Carolina is at 3.3%. And again, if we add a reference point, again, we're not at this low of a rate very often. So the employment section of the economy is actually very, very healthy. We can also look at the initial claims for unemployment. Again, very, very low. So I'm declaring that the unemployment figures, all of that is expansionary. So layoffs are also very, very low. And then we have job openings. Job openings has definitely come down. We were at all-time highs, but job openings have definitely come down. So I'm going to put that one in the category of recessionary. The reason we talk about Dr. Copper is because there's so many uses of copper for industrial purposes that it is frequently referred to as Dr. Copper because they say copper has a PhD in economics. If you look at the chart, you can see that the price of copper comes down when we are in a recession. So what's Dr. Copper saying right now? Well, if we zoom in a little bit, copper has definitely came down last year. It moved higher. Lately, it has shifted to the side. So I would actually argue that is inconclusive. So we'll add this to our scoreboard, and you can see based upon the charts that we looked at today that there are a lot more that are suggesting that we are in an expansionary environment, and only 2 that are really suggesting that we are in a recessionary environment or that we are approaching a recessionary environment. So from the very beginning of this year, even into the fourth quarter of last year, when we started to hear the loud cries of a recession is coming, a recession is coming, we've been skeptical from the beginning that we're going to see a recession in 2023. Now again, to recap, the yield curve that we looked at, that does have a perfect record so far of declaring a recession. But again, it remains to be seen on whether or not that record is going to be unbroken or if the current yield curve inversion is simply a current false signal. Now, one of the things that the Federal Reserve has really been working on is inflation. On the screen right now, we have the Consumer Price Index. We have the information going all the way back into 2000 on the screen. The red line represents a 10-year average. And you can see that we were at 40-year highs with our inflation, but the Federal Reserve has arguably done a pretty good job of bringing this down. Right now, the latest update is inflation is at 3.1%, and that is really close to the 10-year average of 2.6. Now, they're going to try to get inflation down to 2 to 2.5. That's their target, but they're really getting close to that. So far, inflation has gotten a lot better. However, now we're showing you what's called the M2 money supply. And for the sake of time, I'm not going to bore you with this, but This is the amount of money that is available in the economy, and what many would argue that this is the leading cause of inflation. And you can see that this chart was trending lower, but it has recently ticked back up. This would be one of our big concerns on why we think the battle with inflation may not be over. And I would argue this probably should be on my scoreboard, because I would probably put this as at least a cautionary warning that this does concern me. This is from earlier in the year, and what I want to show you is that earlier in the year the consensus outlook for real GDP growth was 0.3%. This is from the Federal Reserve Bank of St. Louis, but what I want to highlight here is look at their historical accuracy. This is their website saying that the Federal Reserve has less than a 50% accuracy rating in some of these numbers in terms of their GDP range. Now, that said, in terms of what do we expect to see for the third quarter, this comes from the Atlanta Federal Reserve Bank and their tool called GDP Now, updated August 1st, and that tool is at the moment suggesting that third quarter GDP might be positive 3.9%. That is again an expansionary statistic. Here we have the Conference Board. The Conference Board is suggesting 2023 is going to post a positive GDP. They're still suggesting that fourth quarter is negative. And they're also, if you look one more tick to the right, they're suggesting that the first quarter of 2024 might also be negative. So we are definitely still seeing economists predicting a recession in the coming months. However, I've also shown you that the data suggests, but their own data suggests that their accuracy in predicting these recessions is actually pretty low. And the reality is they've been predicting a recession for more than a year, and now all that's really happening is they just keep moving back the start date of this recession. Eventually, they're going to be right. I don't know if we're going to see a recession or not. I do know that the yield curve is the most reliable predictor of a recession, but I've already mentioned it twice. It could very well be printing a false signal at the moment. We don't know. Here's our conclusion. We may not see a recession in 2023, but it does seem reasonable to conclude that we may very well be in a longer-term stagflationary environment. The reality is inflation has come down. It is definitely better than it was. We remain concerned that it's not yet under control. And until it really is under control, we are concerned that we're in more of a stagflationary environment. So whether or not we see a recession this year or not, the answer is the same. We would recommend that you maintain strong cash reserves. This is true for individuals and corporations and small businesses alike. Maintain strong cash reserves. If you've got variable rate debt, pay it off. You want to trim the fat any place in your budget that you're not really using, then trim that fat, trim that expense. And if you're going to try to continue to grow your business, we would just encourage you to continue to seek wisdom and grow wisely and prudently. So we'll land the plane here. If you have any questions, feel free to reach out to any member of my team. Thank you for watching. And we certainly thank Linda Parsons and the Chamber of Commerce. And if you find these videos helpful, we would certainly encourage you to send Linda a thank you for suggesting this. And we'll talk to you soon.